for you to be feverishly, working for 8 straight hours. And that's not really the way it's supposed to work. It's designed to give you the opportunity to sort of work it out, figure it out, plan your answer, write your answer, polish up your answer, make it neat and clean, and that sort of thing. I'm not going to grade you on style so much, but you should have time to deliberate over your answer, not be rushed. Now, and that's in my experience, students have found it to be that way, that it's not time pressured because of that. Now, that means that doesn't mean you should learn anything during the exam, right? I don't think that that's an appropriate approach. Would be for you to figure out, what reorgs are during the exam. So it's not giving you that much time, but I would study for it like an in-class exam, and approach it like that. And then the only other time I think students sometimes will have time pressures if you take sort of some wrong turns and then you have to dig back out. I mean, I guess one of the benefits of the structure is that if you do kind of like go in the wrong direction and then realize that you do have time to dig yourself out, then you might also be more time pressured if you do that. And I can't really help that situation. Other questions? Okay, and then before we get back before we do the review, I just wanted to mention there's one code section, section 199 Cap A, the so-called pass-through deduction. I'm not going to hold you responsible for it, but I think you should at least hear it from me. And where it's relevant to what we've covered is for S corps. So Congress, when it lowered the corporate tax rate, as we know, from 35% to 21%, there was some significant, and that was done mostly for international tax reasons, of multinational corporations, for competitiveness reasons. We're pushing for lower rates, and then also because of tax havens and the like, they were sort of like necessitated some lower rates, and it was pretty well universal, the sentiment that the corporate rate should come down. The Democrats, thought more like 28 or 25%. But then there was a thought, well, what do you do about small business? So if you think about your public company, your C corps, they tend to be your huge businesses, your publicly traded. So they were getting this huge benefit of this rate cut, and the mom and pops were not getting anything. And so they put in this pass-through deduction. It applies to partnership income. It applies to S corp income, your so-called pass-throughs or flow-throughs. It also applies to just independent contractors. So if you just have your own sole proprietor business and your activities get put on a Schedule C on your tax return, you're eligible for it as well. And where it applies, it effectively says you're only going to be taxed on 80% of your taxable income instead of 100%. So another way to say it is like you're paying tax at 80% of your normal rate. So at 37% rate, your effective rate would be something just shy of 30%. Because that's 80% of 37%, something like 29.6%, or something like that. So that's the general gist of it. And so when we covered S corps, there would be the potential for the pass-through deduction. There are certain technical things about what's eligible for the pass-through deduction, and certain phase outs depending on how much wages you pay and the like. We won't get into it here, but you should know that it exists out there, at least for now. It'll be interesting to see with Biden tax reform what happens with the pass-through deduction. It doesn't make that much sense to say, well, just because big companies get it, pass-through should get something similar. I mean, that's sort of the argument that was made. The one response to that would be, well, if you think it's so great to be a C corp, go be a C corp. I mean, you can do that. And I think for many reasons we've discussed today, people are not that interested in being a C corp, even with the lower rates. But anyway, we won't get into that. So 199 Cap A won't be an issue. You should not address it on the exam, but you should be aware it exists. And we'll see how long it stays in place. All right, any questions on that? Okay, so the review. So we started out, I'm just going to go chronologically here. We started out back in the day with section 351. So we're talking about the formation of the corporation, contributions of property to a corporation. And when you see a fact pattern like that, where you see people contributing property to a corporation in exchange for stock, then that tees up a 351 issue. You have to ask the question, does 351 apply? And we know for section 351 to apply, that the property transferors in the aggregate must control the company immediately after. Control meaning 80% of the stock if it's one class of stock. A little bit more complicated if there's multiple classes of stock. And the concept of the property transferor group, the control group, we talked about that. The property transfers don't have to be simultaneous, but they have to be sort of one part of one transaction. And we talked about how generally it's pretty easy to qualify under 351, at least the initial incorporation transaction, because the only shareholders who are not in the numerator would be service providers, people who contributed only services, or people who bought their shares from a property transferor subject to a binding commitment of that property transferor to sell. Where it gets harder to qualify would be an existing corporation where you already have shareholders called old and cold shareholders. And if someone comes with property that wants to transfer, well, the only property transferor is the new shareholder. We talked also about maybe the old shareholders could make transfers as well, so-called accommodation transfers. And there are rules for that. If it's too small, those accommodation transfers won't be effective. We talked about that. But that's a lot harder, the midstream transfer of property. But the initial is generally fairly easy to qualify. But that's where you start. Is it a good 351 transaction or not? If it is, then you have to figure out gain, any gain recognized by the property contributor. And that gets interesting if there's boot received by that property transfer. What's boot? Boot is going to be cash. Boot would be a debt instrument of the corporation. Boot would be other property. We didn't really cover other property, so we pretty much limit ourselves to cash and debt. And the boot rule in 351B says that the transferor recognizes gain, recognizes the realized gain up to the amount of the boot received. So, or we talked about it, the lesser of the gain realized and the boot received. And of course, gain realized is your amount realized over your basis in the property. So we talked about how you want to be systematic. Let's figure out the gain realized first. Again, students are sort of tend to jump right to the boot, and sometimes the gain realized is less than the boot. You can't recognize more gain than you realize. But whatever gain is recognized is going to be included in gross income. And then the next question would be, well, what's the corporation's basis in the property received? What's the shareholder's basis in the stock received? And the shareholder's basis in the stock received is determined by section 358, and it preserves the non-recognized gain remains built into the stock received, that formula in 358. 362, the general rule is that the corporation takes a carryover basis in the asset plus any gain recognized by the transferor. And that's the general idea. No loss is recognized to the contributors. And one other thing, two other things to point out. One is going to be, what about debt that's assumed by the corporation? Well, 357 says that in general, debt assumption is not treated like boot, but then we have some exceptions. So one is the sort of the bad debt, the non-bona fide debt assumption in 351B, 357B, which treats that if you do have a sort of a bad purpose debt or bad purpose assumption, then the debt assumed is treated like money for boot purposes. And then we also have our 357C rule, which says that even if it's not a bad purpose debt, if the debt that is assumed by the corporation exceeds the contributor's basis in the property contributed, that excess is going to be gain to the shareholder. That's the 357C gain. We talked about that's simply to avoid negative basis. Because if you fail to apply 357C in that context, then you'll end up, once you do the math, with negative basis in the shares, which you should then realize that you've done something wrong. So that's 357C. And then finally, and I'll take any questions, is we've got one other thing, 362E2. We said generally the corporation takes a carryover basis in the property plus any gain recognized. In 362E2, if the property that's contributed has a net built-in loss, property or properties have a net built-in loss, then 362E2 will reduce the corporation's basis in those properties down to the fair market value. Congress was concerned about duplication of losses. And that's, again, 362E2 is a shareholder by shareholder analysis. So if a shareholder contributes property with a built-in loss or properties with a net built-in loss, then the corporation is going to not take a carryover basis, but instead take the lower fair market value basis in those properties, property or properties. It gets a little tricky if you have multiple properties and you've got to allocate the basis reduction. And 362E2 provides a mechanism for calculation for doing that. So in terms of just issue spotting, I think that's one of those that doesn't arise all that commonly, and then it's kind of on its own. So I just would probably, in your outline or flow chart or however you want to approach this, just keep in mind that this, if you have built-in loss property being contributed, let's check 362E2 and see if that applies. It would have no relevance if you have built-in gain property being contributed. Well, if it's one property built-in gain, you don't worry about it. If it's multiple properties, then if all the properties are built-in gain, you don't have to worry about it. But once you have a built-in loss property, at least you've got to think about it. And there's an election, by the way, we talked about too, 362E2, that in lieu of reducing the corporation's basis in the property, the corporation and the contributing shareholder can jointly elect to reduce instead the shareholder's stock basis. So that's an election that can be made, and we thought about situations where that might be advisable. So that's 351, and then just to circle forward, we did talk about 351 in the context of a acquisitive transaction. So you can use 351, as we saw, where you have the NewCo, and what NewCo ends up acquiring is not, property like in the traditional sense. It's not going to be equipment or land, but instead stock of another corporation. That's pretty common to set up a NewCo and have shareholders contribute their shares to the NewCo in exchange for NewCo stock. And so you might see 351 in that context. The operative rules that we all discussed are the same, but that's a sort of a new context. And in fact, in the subchapter C world, where you see a lot of 351 is going to be in the context of an acquisitive transaction. Okay, any questions on 351? Okay,
Yeah, you might have answered
yes.
it through that, what you just said, but for persons in 351A, does that include corporations as well?
Person, yeah, so a person in the code, actually persons is defined in 7701 of the code. 7701 is a long definitional section. We saw, I actually think 7701A1 is defines person. Let me turn there. Yeah, 7701A1 defines person to mean and include an individual, a trust, estate, partnership, association, company, or corporation. So it's very broad to include basically any person, any individual entity that's recognized as a separate person for tax purposes. So you could have so you could have a corporation be a contributor. So, yeah. Most commonly, persons are individuals, corporations, partnerships. Other questions on 351? Okay, then we started talking about distributions, and with respect to stock. So distributions on stock, and this is the whole double tax, right? The corporation, when it earns money, pays tax, and then when it distributes those profits, the shareholders pay tax again in the form of a dividend. So 301 is a rule for distributions, for non-liquidating distributions, and we know that we have the 301C waterfall that you're going to the extent a distribution comes out of earnings and profits, it's a dividend. Then once you've exhausted the earnings and profits, then you start to reduce the basis of stock. And then once you've reduced the basis of stock down to zero, any excess is going to be capital gain long-term, assuming you held the stock for more than a year. And then the interesting stuff, or the more complicated stuff, comes in when, well, how do you determine what comes out of earnings and profits? So we have this concept of current earnings and profits and accumulated earnings and profits. Current E&P is the earnings and profits that accrue this year. And you take that amount before dealing with any distributions, and you would, if necessary, if you have enough current to cover all the distributions, it's all a dividend. If you don't have enough current to cover all the distributions, then we know that you prorate the current across the distributions. So you prorate current and then accumulated, then you turn to accumulated. And with accumulated, you drop the accumulated earnings and profits on a chronological basis. So the earlier distributions take priority over the later distributions for accumulated earnings and profits. And there are problems we went over in class. There are problems in the regs. And then the one permutation that I think is sort of the least intuitive is where you have negative current earnings and profits and positive accumulated earnings and profits. And in that case, we said you're going to apply accumulated earnings and profits, the net positive, but you prorate the current year loss to determine the accumulated at any point in time. Again, that's abstract, difficult to explain without a problem, but we did a problem there. And so, get comfortable with that. It's really not that difficult, but you just have to work it a few times, I think, in your mind and get it straight. So that's current versus accumulated and that sort of thing. We also, another complexity would be if we have a distribution of property rather than cash. And the key to that, the reason why that's interesting is because cash, we don't have any gain or loss when we distribute cash. There's no built-in gain or loss in cash. But there could very well be built-in gain or loss in property, and would be as long as the fair market value does not precisely equal the basis of the property. And so the 311 gives us a rules there for what happens when we distribute property. And the rule is that on the 311A, any built-in loss is not recognized. So the built-in loss when property was distributed, the loss is not taken into account, does not result in a loss that reduces the corporation's taxable income. But if you have distribution of appreciated property, property with a built-in gain, then that built-in gain is recognized, and that increases taxable income, which increases earnings and profits. And that's consistent with the idea, again, that we double tax corporate earnings, and the appreciation that occurs in the corporation's hands is corporate income. So we should keep that in mind as well. And that's 301 and 311. Any questions on that? Okay, the next thing we dealt with was redemptions, buybacks. So here we don't have a formal distribution, but 302 treats certain redemptions as a distribution, recharacterizes it and says, we're not going to treat it like a sale of stock. Instead, we're going to treat it like a distribution on stock. And the key to 302 is whether we do recharacterize the transaction as a distribution, in which case we get kicked into 301, or whether it's respected as a sale or exchange, in which case we just figure out the amount realized and the basis of the stock, and we have gain or loss. And we talked about why it may matter. If it's a sale or exchange, you get to use your basis in the stock. If it's a distribution, the basis is going to be not used currently. It'll be shifted over to your other stock. If you have gain or a loss, it's going to give you, if you gain, it's going to be a capital gain, which capital losses can absorb, but dividend income can't be absorbed. If you have a foreign shareholder, dividends received by foreign shareholders are effectively taxed through a withholding tax, but capital gains recognized by foreign shareholders are not taxed. And finally, if the buyback price is paid in the form of a note, if it's a sale or exchange, the selling shareholder can report the gain on the installment method, meaning over time. Whereas if it's a distribution, the entire note is treated as dividend in year one. So for those reasons, it may well matter whether you have a redemption respected as a redemption or instead recharacterized as a distribution. And the key here is going to be to apply the 302B rules. You want to see whether it's covered by the 302B rules, and we focused on 3 of those. And the most quantitative is the substantially disproportionate rule in 302B2, which is just math. I'm not going to go through the details of that test. It's all right there in the code. Not to say it's easy, but you should be able to work out problems under 302B2. And it's nice because, again, it's very quantitative. You can give an opinion, a will opinion in certain cases. You can guarantee the result because it's just math. There's no subjectivity. There's no argument. You either meet it or you don't. Now, if you don't, that doesn't mean you're dead in the water. You have 302B3, which is the complete termination rule. Again, the facts are going to have to be such that you you've redeemed out all your shares. And it's not substantially disproportionate because of the family attribution rules, but 302B3 allows you to waive the family attribution rules in certain circumstances. That's also fairly quantitative. I mean, you can get into some issues. We talked about how, whether you continue to have an interest in the company in some respect could be debatable, like you talked about if you were a consultant. But generally, that's also pretty quantitative. But again, it's pretty narrow. The facts have to be such that you no longer own any shares at a minimum. The last one, if those two don't apply, is the old facts and circumstances test. It's 302b1, not essentially equivalent to a dividend. And the Davis case explained that we're looking for a meaningful reduction of the shareholders' interest in the corporation. And that can be very facts and circumstances. There are some good revenue rulings that are helpful, particularly with regard to voting power. And basically you can make some arguments, sometimes pretty powerful arguments, that even though you haven't been reduced enough to qualify as substantially disproportionate, you've really affected in a meaningful way your power. So that's where you're focusing again on things like voting blocks in closely held corporations, certainly moving down from a 51% position to a 49% position where you don't have lots of other shareholders. That's pretty meaningful, even though it's only a few percentage points down. So that's where you'll make arguments. And you'd have to use your judgment if there's a fact pattern there. I mean, most of the stuff I'm going to ask you about is going to be all or nearly all is going to be a clearly correct or clearly incorrect answer. But if we got down to 302b1, then you may have to say, look, it's not clear. Here are the arguments. And you could even tell me which ones you think are the most persuasive, but it's perfectly fine to say, well, not entirely free from doubt, this is what I think the answer is. Okay, any questions on 302? The other thing we talked briefly about is going to be where you have some ambiguity about the transaction. We talked about a situation where if a shareholder has a primary and unconditional obligation, has the primary and unconditional obligation to buy out another shareholder's shares, and the corporation instead redeems the shares, these so-called bootstrap acquisitions, that in that case, the IRS will treat the redemption as a constructive distribution to the shareholder who had the primary unconditional obligation to buy. We talked about that. We spent a class session on that. So that's a threshold question about whether the redemption is even going to be treated like a redemption in the first instance. Do you even get to 302? In that case, if it is a primary unconditional obligation, it's just recharacterized as a distribution to that shareholder who then effectively uses the cash to buy out the other shareholder. Okay, that's 302. So again, 351, lots of stuff I could test you on 351, 301, 302. That's a lot of the course right there. And the rest of the course, I mean, I basically divide the course into three. So you have those issues, which are sort of like your basic subchapter C issues. And then the next set of issues is going to be mergers and acquisitions. That's big topic 2. And then S corps is 3rd. So you can break the course into those 3 sections. And then, but for M&A, we talk about liquidating distributions, which is relevant for certain M&A structures, but it's pretty straightforward that when you have a liquidating distribution by a corporation, the general rule is that the shareholders recognize gain or loss as if they sold their stock for the amount they received. So basis recovery, and there's no dividends on a liquidating distribution. Again, that's the corporation going completely away. And the corporation, if it distributes property in the liquidating distribution, will recognize gain or loss on its final tax return. And there's an important exception to that. That's what we can call a 331 liquidation. The important exception to that is a 332 liquidation, which is where the corporation that's liquidating is owned by an 80% or more corporate parent, the so-called parent sub liquidation. And in that case, the parent sub liquidation, the subsidiary liquidation, there's no gain recognized by the parent, and no gain recognized by the sub either, and the parent just takes a carryover basis. Typically, it's going to be parent owning 100% of sub, and so those rules are pretty straightforward. Again, that relates very closely to M&A. So we go to the M&A, we talked about taxable deals first. And we have the stock deal and we have the asset deal. Stock deal is really easy. Just people just selling their stock to an acquiring company. So they just have gain or loss, it's capital gain or loss. The buyer takes a cost basis in the stock. But of course, cost basis in the stock is not really useful because the stock isn't depreciable. And so that's the stock deal. And taxable asset deal was going to be where T is selling its assets to P. That's going to result in corporate level gain at the T level. And then almost always, the next step will be T will liquidate by taking the cash and whatever other property and distributing it to its own shareholders in liquidation. So that's two levels of tax, one at the T level and one at the T shareholder level. That's the bad news for an asset deal. The good news for an asset deal is that the buyer takes a stepped up basis in the assets of T. That's more useful than a stepped up basis in the stock of T, because stock is not depreciable, but the assets of T often are. So think about things like machinery and equipment. Think about things like goodwill. Think about inventory. If they're buying T's inventory, well, inventory is not depreciable, but inventory is going to be turned over pretty quickly, right? You're either going to sell it or it's going to go obsolete. You're going to end up with cost recovery quickly with inventory. So we talk about how buyers like asset deals because of the stepped up basis in the assets, which reduces their tax liability going forward. But sellers like stock deals because there's only one level of tax instead of two. And we talked about how mathematically the way it works out is that the benefit to the seller of doing a stock deal outweighs the benefit of the buyer of doing an asset deal. So the tax efficient structure is often a stock deal. And we talked about three exceptions to that sort of golden rule, if you will. One is where T has net operating losses, because those can be used to offset one level of tax. Two is where T is a controlled subsidiary of another corporation, 80% or more subsidiary, because the liquidation is tax-free, avoiding one level of tax. Or where T is an S corp, and S corps don't pay tax, avoiding one level of tax. So the way tax lawyers think about this is that if you're in those three categories, then things are interesting. We can spend some time and billable hours trying to figure out whether it's worth it to do an asset deal or a stock deal. And by the way, we can do that effectively through an election. We don't actually have to literally do an asset deal. We can do a 338 H10 election generally. But if we're outside, if we're not in those three categories, if we have no NOLs, if we're not an S corp and we're not a 80% or more subsidiary, then it's pretty easy. We're doing a stock deal. The buyer may have to adjust her price, its price, because we're talking about P being a corporate buyer, to reflect the fact that it's no longer getting a stepped up basis, but it's gonna make the parties richer by doing a stock deal than an asset deal. that's the taxable M&A context. Any questions on any of that?
Yeah, Professor. In my notes, I had I had a 338 election and the 338 H10 election.
Yeah.
Is there a difference for our purposes?
Yeah. Not really. I mean, so an H10 election is going to be made when we talk about the three situations where you might do an asset deal. In situations 2 and 3, T is a 80% or more subsidiary, or T is an S corp. That in that case, if you want to turn a stock deal into an asset deal for tax purposes, you make a joint H10 election. It's going to be the seller and the buyer are going to make a joint election to recharacterize it. Where T has NOLs, it makes an asset deal attractive, then the buyer can do what they call a regular 338 election. And it's a unilateral election by the buyer, and the buyer is just going to basically say, okay, we're going to treat it as if after the deal, the corporation is selling its assets to itself, triggering the gain, allowing the NOL to be used, and we'll just pay whatever tax as a result, if any, and then T will have a stepped up basis. So there's a nuanced distinction between the two, but what you just need to know is that those are just provisions. Again, I'm not going to hold you responsible for the distinction between a regular 338 election or an H10 election. They're just elections that allow parties to do a stock deal and have it taxed like an asset deal. Just typically, again, not that attractive, but in those three circumstances may very well be. Any other questions about taxable M&A?
Yeah, I have one quick question.
Sure.
In terms of like negotiating the purchase price, I think in terms of a stock deal, I think we said P should discount the price it's willing to pay below fair market value of the T stock. If T is willing to do an asset deal, all else the same, would we also be likewise willing to like gross up the purchase price over the fair market value of T's like net assets?
Right. Well, I think let's just start we talked about how P would pay more for assets than for stock. Again, we're talking about an appreciated business because of the stepped up basis. So you should know generally that P would pay more for the assets rather than the stock. How much more, I can't require you to do that kind of analysis. It would require present value analysis and the like. But yeah, if P were to insist and say, so again, what would typically happen if parties were negotiating among themselves, and P says, hey, I'll buy your assets for X dollars. And then the tax lawyers come in and say, yeah, that's just dumb. You don't want to buy assets for X dollars, or you don't want to sell assets for X dollars. It just doesn't make any sense. Better for everybody involved if P just reduces X by the value of the step up and then buys the stock. And what that would do is should put P in the same position, because P is paying less but also getting less, and would leave the T shareholders with more cash in their pocket. So that's typically how you might see that play out. It's just prohibitively expensive. Well, and then I guess you could say to P, if you represent the T shareholder, say, okay, if you really want to buy the assets, then you need to pay more. But again, it's going to be most efficient tax-wise to have P buy stock and reduce the price it's willing to pay. Okay. It's just, if you think about, like, there's three parties at the table. There's buyer and seller and the government. And when you do a stock deal in a typical case, it's going to leave the buyer and the seller collectively with a bigger chunk of the pie and the government with a smaller chunk. So if then you do an asset deal, it's typically going to leave the buyer and the seller with a smaller chunk and the government with a larger chunk. And so unless they're feeling particularly gratuitous towards the government, the parties, are going to be better off. And the next question is, well, who benefits from that surplus you're creating, right? And that becomes a bargaining position. But that's usually the way it goes. Okay, any other questions on taxable? All right, and then we move to tax-free. And so now we're talking about reorgs. And we have the threshold question about, is it a reorg or not, right? A lot of work as to what, do we have a reorganization? And I think it's useful to divide the world up, like the Schler article does, between reorgs where T stays alive and reorgs where T goes away. And where T stays alive, we could do a B reorganization, but it has to be solely for stock, for voting stock, solely for P voting stock, a very strict no boot rule, solely for P voting stock. And P has to have control of T immediately after. Another reorg where T stays alive is a reverse triangular merger, an A2E, 368 A2E. And that's where control of T has to be acquired for P voting stock. So if P has no pre-existing ownership of T, then up to 20% of boot can be paid. If P does have pre-existing ownership, then that 20% gets reduced. And so where T is going to stay alive, you can use generally a little bit of boot in an A2E, no boot in a B. They have different sort of issues with regard to the creeping transaction that we talked about, but that's a general idea. And where T goes away, you have much more flexibility. You could do an A reorg, sort of a straight A, merging T into P. And in that case, you can use up to 60% boot, right? Because the continuity of interest rule is going to be the key, and you just need 40% continuity. And we talked about how you could do an A by merging T into P's wholly owned LLC. You could do a forward triangular merger, an A2D, 368 A2D, and again, likewise, use a whole lot of boot, and your biggest constraint is the continuity of interest rule. And then finally, if you, for whatever reason, can't use a merger or don't want to use a merger, again, it's hard to think about why. And historically regulatory, non-tax regulatory issues like nuclear power might not be able to do a merger. But if you are stuck with doing what they can call a de facto merger, where you're selling all of your assets to T, then it could be a C reorg. But again, you're going to have a very strict no boot rule if P has significant liabilities, because once you have actual boot, you start counting the liabilities as well. And then we talked about multi-step, right? And this is just something I think you got to keep working the problems and thinking about this, but it's just once you get a good feel for it. But basically, I think about it as sort of like you have a bunch of transactions. If it's part of one transaction, and I'll use language like in an integrated transaction or as part of a plan. Those are your magic words. Things are happening as part of a plan. They get integrated, and you're basically going to look and see, does T stay alive? Does T not? Does T go away by merger? Because if T goes away by merger, then you're looking at an A or an A2D, depending on whether it's merged directly into P or into S. And trying to fit it into the box of which reorg class it gets tested under to apply. And we probably did pretty much all the permutations that are out there throughout between what's in the book and the revenue rulings and what we did in class. And with multi-step, once you conclude it's a reorg, it's a reorg, we get into that weird situation where if you go through multi-step and it's not a reorg, it fails. Then we talked about how if the first step is a qualified stock purchase, then it'll be treated as a taxable stock deal, followed by whatever comes next. Any questions on qualification as a reorg? But once you do have a qualification as a reorg, then you got to say, what are the tax consequences? And the most interesting ones are potentially at the shareholder level, the T shareholders, and if they receive boot. If they don't receive boot, then it's just no gain or loss recognized, and the stock basis just carries over. But if they receive boot, then under 356A1, they recognize gain. Again, familiarly, lesser of the realized gain and the boot received, just like the 351 approach. And if you do have gain on the 326A1, then the next step is to characterize that gain, and some of that gain could be characterized as a dividend under 356A2, and that's under the Clark test. And that's the Clark recharacterization as sort of a two-step, as if you received only stock in the reorg and then had some of the stock redeemed in the second step to get to where you are. And you would test that hypothetical redemption under 302. So it'd circle us back to 302. That's been a popular thing for me to test on lately because, you can test reorgs and 356A1, and then you kicks you into 302. Any questions on that? Clark, 356A2. It's probably the hardest thing we did, maybe. Yeah.
And Professor, I have one question. Under the 302 test, we do go for all three of the 302 questions. I mean, there's normally no complete redemption, but then we ask ourselves whether it's substantially these calculation, disproportionate. And then in the last question, we might also go for the circumstances test.
Well, if you're in 302B2, then you're done. That's a sale or exchange. So you'd only once you get into one, once you say one of those applies, then you're done. So yeah, how I would normally approach it is, again, if it's a complete termination without regard to family attribution, then you kind of look at 302B3. That kind of jumps out at you. And if it works, it works. If 302B2, again, if it's a disproportionate, then it's done. But if you go through those and it doesn't work under either of those, then your last step is 302B1. It's kind of the last one to apply because it's the most uncertain, right? Okay, and then like I said, with 351, we can use 351 as an acquisitive technique. We talked about the horizontal double dummy technique, and again, where you'll set up a NewCo to effectively acquire P stock and T stock, and it affects that combination of P and T using 351 instead of the reorgs. And why would we do that? We do it, again, if we want to keep T alive and we want to use more than 20% boot, we can't use a reorg, but we could use 351 in the horizontal double dummy technique. And then we talked briefly about tax attributes, basically T's NOL. In a stock deal or in a reorg, T's NOL is going to, at least in the first instance, stay alive. But then we talked about section 382, that when you have an ownership change, which inevitably these M&As will involve, that you have the limitation of your NOL utilization. It's a function of the fair market value of T at the time of the ownership change times the long-term tax exempt rate, which we said was in the low single digits. And so again, we didn't really do much quantitative stuff there, but you should just appreciate that T's NOL could be subject to that, well, would be subject to that in ownership change. And that's usually a problem when T is not doing well. If T is Uber, Uber's got lots of NOLs, but Uber is super, super valuable. And so Uber's not worrying about the 382 limit because it's going to be very high. But it's becomes more of a problem when T is kind of a middling or failing corporation. So don't worry so much about, or much at all about NOLs, but you should know that we have that potential limitation. Of course, if T is sold in an asset deal, T is going away, and the NOLs that are unused would dissipate. So that's M&A. And then the last topic we talked about was S-Corps. And since we just talked about these, I won't go through these in too many detail, but I think there's eligibility issues, whether you can make an S election. We talked about things like single class of stock. We talked about things like no entity shareholders. Those are pretty significant limitations. We talked about allocations. How does the S-Corp's income get allocated? Because the S-Corp doesn't pay tax generally. So all of the S-Corp's tax items like income, gain, loss, or deduction flow through to their shareholders. And it's pretty easy allocation. I know some of you are in partnership where it's really tricky how to allocate. Well, with an S-Corp, it's really easy because each share gets a prorated share. If you own 1 out of 100 shares, you get 1% of each and every item that the S-Corp recognizes. We talked about how when you get allocated income, your outside basis, your stock basis goes up. When you get allocated deductions and losses, your stock basis goes down. We talked about suspended losses. If you have insufficient stock basis to absorb your losses, those losses get suspended under 1366D and are carried over to the next year, subject to the same issue. So those are allocations. That's what creates the tax consequences. Then we've got distributions by S-Corps. And we divide the world up to S-Corps with no E&P and S-Corps with E&P. With S-Corps with no E&P, then you just reduce stock basis by the amount of distribution, tax-free distribution to the extent of stock basis. Once you get stock basis down to 0, any further distributions are gain. If you do have S-Corp with E&P, then the waterfall is slightly different. You reduce stock basis and no gain up to your AAA account, which is effectively your E&P. AAA is effectively like your E&P account while you were an S-Corp, but without tax-exempt interest in it, tax-exempt income in it. Once you eat through your AAA, the next layer is dividends, the extent of E&P. Once you eat through your E&P, the next layer is reduced stock basis down to 0. And then once you reduce stock basis down to 0, any further distribution is gain. And then the last thing we talked about briefly is S-Corp taxes, and the big one there is 1374, the built-in gains tax. And there's a lot of mechanics there, but what you need to realize, again, is if you have a C-Corp with appreciated property and you convert to an S, any sales of that appreciated property within 5 years may very well trigger this is 1374 built-in gains tax, which is going to depend on the amount of built-in gain in that property that's sold and the amount of built-in gain that exists on the S election. And that basically it's not easy to avoid, right? You can't just say, oh, I'm going to make an S election and then sell the next day. That's not going to work. 1374 is going to prevent that. If you make the S election and sell in 5 years in a day, then it'll work. And that's pretty much it. So again, I'm going to let you go in a few minutes here, but I can 351, one is a major set of issues, 301 distributions, 302 redemptions, M&A, which I would include taxable and tax-free in that broad category, and S-corps. So that's kind of 5 major topic areas that I would expect the bulk, if not all of the points on the exam to come from those 5 major areas. Any questions? Okay, so then on Wednesday, we're going to go over the exam, sample exam. So now I'm going to let you go early. I'm going to ask you to do the teaching evaluations, which you can do on My Georgia Law. So we're asked to give you classroom time, which is what I'm doing, so you can do that. So I hope you will do that. And I'll see everybody on Wednesday. Max, quick question.
Yeah, very quick question.
Yeah.
Enp calculation, what goes into Enp and all that, is that something you also may ask for?
Yeah, I mean, but Enp, we talked about Enp it's basically like your taxable income, and then you make some adjustments. So taxable income, and then you add things like tax exempt income. And then there are some adjustments for like depreciation schedule that we didn't, I wouldn't do too much there. So I don't think there's a whole lot there, but you should understand that Enp is another calculation of income. It's much like taxable income with some things that you vary. And yeah, I'm not that much of a sadist that I'm going to, make you recalculate depreciation schedules and the like, but you should generally understand how it works.
Thank you.
Okay. All right. I'll see everybody on Wednesday. Thanks. Bye-bye.